Are you an ICT trader that struggles with taking trend continuation trades? You've been taught that you have to take reversal trades, the classic sweep of liquidity, market structure shift, and return to a fair value gap. But what if I told you guys that there was a way to get involved in trending markets? And today that is going to be the whole focus of the video, to unpack the way in which I approach trending markets, because maybe you've missed that pivot, maybe you missed the initial reversal and you're not confident taking a continuation trade. Today I hope to give you at least two ways or two models that I personally like to use for trending markets, and it's going to focus on macros but also low resistance liquidity. If you're not subscribed already, guys, hit that subscribe button and turn on the notification bell to stay updated with all my YouTube videos. But let's get straight into this video. Now, before you even look at entry models or show you entry models or strategies, you have to ask yourself a bunch of questions. This is what I ask myself every single day if I'm taking a trend continuation. Number one, do I have a clear draw on liquidity? Because obviously I'm entering the move slightly higher up or slightly lower down. Is there still a clear internal and a clear external draw? Really crucial that you ask yourself that. Number two, are we sitting inside of a macro? Are we close to a macro? And number three, am I in a level of premium and discount, or am I sitting roughly at the equilibrium level? You have to understand these concepts before we move into the models. Now, assume for 1 second that you missed out on any opportunity to go short right from here. So for example, you come to the markets late, or you're just not sure, you want to wait for a bit more confirmation. So you see price react from this 15-minute fair value gap. And often these are spots where high probability reversal trades can take place from. And you see that, but you say to yourself, I want a bit more confirmation. So you go back down to the 1 minute time frame, but you're still not confident. You still don't enter, and you're wondering if you're going to get another opportunity to enter the price action. So you see price play out, it pulls back up, it gives you another opportunity, and you still don't enter. For whatever reason, you're still fearful, and you're looking for an opportunity now that the market has started to move in the direction that you want it to move it in. Now, looking at price action here, obviously there's a few entries to go short at the actual reversal point. So you might have used this inversion fair value gap to go short from, but you might be like, no, I want a bit more confirmation, but how do I enter now? The price has already started to develop. How do I enter? Ask yourself those questions. Number one, are there clear draws on liquidity still? Yes. Where are the clear draws on liquidity, guys? We've got this swing low resting here. We've got this swing low resting here. Notice how these swing lows, they're relatively equal. So always try and target low resistance liquidity or relative equal highs and relative equal lows. So we've got these. Then ask yourself, are we approaching or are we close to a macro? Why are we, asking ourselves that? It's because the macros can spool towards liquidity. They can move quick, right? The macros are time frames where the market can spool and can move towards liquidity. So if I mark out the macro now from 10.50 to 11.10, we can ask ourselves that. And we are close to a macro. We do have a clear draw, but we missed out on the original opportunity, because for most people, they're going to be going short from here, right? Stop above this high and then maybe targeting what they need to. You're trying to look for an entry now because you're waiting for more confirmations, or maybe you just went at the charts, but where can you enter from? I'll show you a way to enter. So number one, look for any inversion fair value gaps on this side of the curve that get created. So for example, here, you've got this bullish gap that gets inverted, extend that across in time. If we tap back into that, that could be an opportunity to go short. Or maybe you like to enter off different PD rays, right? Now what you see here is you see this bearish gap, and notice how in this situation, you have two PD rays paired on top of each other. So if you ever enter in a trend continuation model, it's ideal to have more than one PD ray paired on top of each other for further confirmation and confluence. Could you enter here? Yes. Where do you put your stop loss? You do something like this. Stop doesn't need to go all the way up here. Why don't I want my stop loss up there? Because I want these swing highs to hold price. We've just swept this level of buy side, guys. We've just swept the level of buy side. We've just reacted after doing so, and we're trying to catch the second portion of the move. After a period of accumulation, you want to have a quick and aggressive move. Now, all the trades I show you today, the trade ideas, the models, these are things that you should forward test, and it's going to apply based on the different sessions and the different market conditions. Now, we expect, before this macro starts, we expect this macro to spool towards that sell side. Let's see if we get that. Beautiful, right? So you're pairing low resistance liquidity, in this case, relative equal lows, with a macro, with any PD ray that you choose, and then putting your stop loss above the high that just swept liquidity. Nice and easy. Now, at this point, if you said to me at this point, Ruben, I want to go for a short, I'd say, you're too late. You're too late. Why would I say you're too late? Because these are the clear draws on liquidity. Of course, could price come all the way down here? Of course it could, but it becomes more and more risky as you start to move down the move. as you start to move down in price action, the risk increases and increases and increases and increases, because when we have that pivot, this is the last major swing low and this is the last major swing high. So what you should be doing is grabbing a Fibonacci or whatever you might use from the swing low to the swing high, and always mark out, or even just in your head, like reference roughly where this level would be and mark out the 0.5 zone like this, right? So if you mark out the 0.5 zone, if you can take a trade above 0.5, beautiful. Ideally, what I say to my Discord, if possible, if you can take a trade above or at the 0.25 level, that is ideal. But a trend continuation model is a little bit lower than this, and anything lower than this, I'm just going to say, unless there's a really clear draw on liquidity that you haven't taken out, it's extremely risky. Now, the next example I want to get into is looking for a trade once this uptrend has already started. So for example, this is from Tuesday the 10th of December, and maybe you're trading the London session, you're thinking, how do I get involved in this price action? Look how choppy it is. You come back later, you see the price has moved up, you still believe price is going to move higher. Why do you expect that? Because you might expect price to come into the 15-minute fair value gap that we talked about in the previous example. So what do? How do you enter a trade when the trend is already started? What do you do? What do I look for? This is exactly what I look for here. So zooming into price action, have a look at what we've got here. We've got an impulsive leg up and then a small trickle down. That small trickle down, and here's where you've got to use optimal trade entry. You mark out the OTE range from this swing low to this swing high. You draw that across, and what you're looking for price to do is you're looking for price to sweep liquidity or react from optimal trade entry around a macro time frame. So we've pushed up impulsively, we trickled back down. We mark out our macro, and again, every single hour there's a macro. So the macro rests from 550, which is there, all the way to 610. And your entry comes from whatever PD array you like. Like you could enter from an inversion, or you could enter from this bullish fair value gap. But you need price to have an impulsive move up and then a slow trickle down. You don't want it to go up and then straight down. It has to go up like this and then a slow trickle down, because what that does, that generates liquidity on the buy side for you to target. You do have a draw internally. This is your internal draw. External draw is up here, which is the 15-minute fair value gap, which is all the way up here. So you've got these targets, but this is how you like, or I like to enter trend continuation moves, using the draw on liquidity, but also using macros and using optimal trade entry. So how do you do this? You enter from here, right? When we tap back in, your stop goes below these bodies and you target what you need to. Often for me, 10 handles is fine, sufficient, happy days. Right, so that's example number 2 of trend continuation models. You can see as the price runs up like this, similar situation happens here. Now we don't dig into optimal trade entry, however, it still is a good opportunity because you can see price, right? If we mark out all these imbalances, we've got this fair value gap here, right? Price sweeps some sell side, which is nice, always a good bonus. But notice how we have an impulsive leg up and then we trickle back down. Then we mark out the next macro, and provided the drawn liquidity still remains there, the next macro is from 650 here all the way until 710. How do you enter this trade, guys? You wait for an inversion, wait for a bullish gap, whatever you like, maybe use this inversion and you enter all the way over here. But notice how these trend continuation trades, they follow the same pattern. But ultimately, forward testing has allowed me to come up with this model, and it provides you with these tight stops, but these big pulls, right? At least a 1-to-1, at least 10 handles. And we could keep doing this time and time again until, right? Until we reach the higher portions of the bigger range. And this is an important topic that we have to talk about and unpack. So as we're riding the trend, yes, this idea is good. Yes, this idea is great. But notice we've got a swing high here, and this is really important. This is a major swing high, and this here is a major swing low. That is a dealing range. Again, mark out your Fibonacci from that range, from this swing high to that swing low. Draw that across, and then just mark out the halfway point. The halfway point. You can also mark out the 0.25. Again, the best entries come from 0.25. We're happy to take trades around the 0.5. As you're getting to these top quadrants, guys, it gets more and more risky, right? So if I marked out the 0.75, you don't want to be entering longs in that top portion, because the market can then reverse from the other optimal trade entry of the bigger range, if that makes sense. So this trade is like pushing at this one here, this trade idea. This one I think is still valid because you're roughly at equilibrium, and we expect price to at least go above equilibrium before pulling back. But notice how as you pull up into price here, if I was to draw this out, it's normal for price to go back up into a premium of this high to this low, and then retrace. So you don't want to get caught on the retracement when you're doing these trend continuation trades. And that's probably my best advice, is to try and take trades around the 0.5 level. You can miss out on the bottom, right? You can miss out on this, but try your best to stick to around the 0.5. And if you enter a bit higher up, the draw on liquidity has to be extremely clear, and the risk, in my opinion, should be lowered, and your target should also be lowered. You shouldn't be going for a 1 to 10 or 1 to 5, 1 to 3. 1 to 1, 1 to 1.5, that'll do the trick. Now this next example comes from the PM session, and my whole idea in this video is to give you guys a range of illustrations that you can then use to forward test and test for yourselves, but ultimately this is what I do myself. Looking at price, maybe you're looking for a reversal, but you don't get it, right? So price does something like this, and you're thinking to yourself, is it too late to enter the trade? Is it too late to enter the trade? And let's go back to those basic principles. Let's talk about draws on liquidity. Let's talk about dealing ranges. Firstly, let's do the dealing range, and let's go from this swing low to this swing high. That's the most recent range. And what I want you guys to look at is the same thing here. So swing low, swing high, let's mark that out. 0.5 is roughly here. We don't want to enter shorts if it's down here, but if it pulls back up and there's a PD array that supports that, we might be interested in actually taking that short. Let's have a look. All right, I'll pull them back. Now here is valid, it's viable. However, a lot of people get burnt because a lot of people, including myself when I first started, I used to just enter straight away off the retracement. Now what I like to do, I let the retracement happen and I wait for a rejection candle in my desired favor or in my desired direction. So what I want to see is I want to see price reject, and then I can enter with a tighter stop loss. Beautiful. That there becomes an entry, right? There's your entry to go short. You can put your stop above this fair value gap, right? Or above these bodies, if you like. Just give it a little bit of room, but ultimately you could do that if you want to, that's fine. Because you don't want price to come back above that green candle. And where do you target? Anything down here. The lower down the move, the less you should target. That's what I like to do. The same with if you're trending up, the higher up the move, the less you should target. Now let's see what happens with price. Beautiful, right? Now, if price is sitting here, would I say it's too late to enter? Yes. Too late. You've missed the trade, accept it, move on. Why do I say it's too late? Because you might be able to catch a short, maybe, right? And yes, price might come down, sweep this low and come down here, but what if price sweeps this low and then reacts back to the upside? In this example, guys, this is from the New York session on Monday the 9th of December, and maybe you missed this pivot. Maybe you missed it, price has come down. You still think price is going to go lower. Why? Because we had this massive move up, and this is the NFP Newsweek. So maybe you're thinking, yeah, we're probably going to come a bit lower, probably going to reach equilibrium of the range, but you're not sure how to get involved. Please, 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 and again, everyone finds their own way, but for me, what I found works best is if you're going to take a trend continuation move and there's no low resistance liquidity on the internal side, you have to be around a macro time frame. So if you have a look here, right, we have this inversion fair value gap, and notice inside that inversion, we also form this order block. This becomes an entry, but why is that entry good? The entry comes at 10:46, 4 minutes before the macro, and I want the macro to spool. Right, so something like this is sufficient. Stop can go above those bodies, and you can let the macro do its thing, right, till 11:10. However, if you don't like that, you just wait, right? Because based on my strategy, based on my model, this may be too far down the range for me to like. I might just want to let the price go, and that's completely fine. And not every move in the market that trends is a move that I want to be involved in, like I said. Sometimes in the London session, I let the move go 40, 50, 60 handles. I'll wait for the reversal. And then if you're patient enough, if you're patient and you wait for things to play out that you're used to seeing, you can see that price then sweeps this NFP wick. And also in the macro, guys, what do you have here? You have a really nice reversal trade from an inversion fair value gap. So the market will reward people who are patient. We can talk through potential ways to get involved in the move. And this is from the London session on the same day. Now let's implement the same strategies. Do we have liquidity to target? Let's assume price is all the way up here and we're not sure, right? We're not sure that we want to go short. The market, it's a bit wacky. Maybe you've got stopped out before. You want to wait for a bit more confirmation. The price starts to develop. You've got this massive candle. It seems as if price wants to move lower. Straight away, ask yourself, do we have any draws on liquidity below? And the answer is yes. We have an imbalance right here, which is a nice fair value gap. And we also have relative equal lows and low resistance liquidity. Like see these lows here and see all these lows, relative equal lows, relative equal lows. So we've got a draw on liquidity, which is fine. Now, Based on our analysis, based on what I was saying with dealing ranges, what we'd need to do, we need to pull a fib and go from this low, that's the most recent low, to this high. And what we need to do is we would need to see if we can get an entry around the 0.5 level. Ideally, yes, the 0.25, but if we can get an entry around 0.5, it could be okay still, but less probability. Let's have a look. So price sells off here. Would I enter right away here? No, not interested. However, what I'm looking at is this. Price has indicated to me that it wants to move lower. On this day, you have to look at your charts, but we had SMT at these highs. So the NASDAQ made lower highs, ES made higher highs. Bearish SMT indicates a reversal. There's a clear shift in structure with this displacement candle. We pull up, we create an order block, and then we displace lower. Right away, my thought goes to, if we're gonna move lower, we should not come above these green candles. So when you're thinking of stop loss placement, those green candles are important. The next thing I look at is I look on this side of the curve for any fair value gap that could be inverted that I could use as an entry. See this one? Beautiful. And then what I'm looking for price to do is I'm looking for price again to pull back into that inversion, to pull back into this bearish fair value gap, but not only pull back, but to react from that point. It's happened to me, it's probably happened to you. It comes up here, it looks nice, and then it keeps going up. You should just wait for the rejection, save yourself a lot of trade ideas and a lot of losing trades as well. So we're about to pull back. Let me just slow this down. Let's see what we do in this area. Now, let's go back to this candle. Is this too late to enter? It's getting there, right? But notice what you've got now. You've got this inversion gap, this sell side imbalance. You've also got this inversion gap here. What this allows you to do, if you're in a trend continuation move, it allows you to have a tight stop. So whenever you're entering trend continuations, you don't want to have a wide stop, which is why entering from this sell side imbalance is not my forte. It's not what I want to do. Don't care about it. Even if I miss a move, who cares? I'm not having a stop that's wide. Now for me personally, I'm not entering a trade like this. It doesn't bother me if I miss out on the move because it doesn't fit my model, so it's not my trade. And that's something that you guys have to get well versed at as well when you're learning the concepts or you're applying your own data. I don't like those type of trades. I don't like having a wide stop like that. It's not what I want to do. So I'll wait for the trend continuation model that allows me to have a tighter stop, right? So if I enter short from here, my stop should be able to go above this order block and price shouldn't need to return there. So my stop is now 9 handles, which means I might be able to increase my risk as opposed to entering from here or from the rejection and then having to have a stop loss. Instead of 9 handles, I'm having a stop loss that's 23 handles. Way too wide, right? Now, what do we target? Because we're so low down in the move, this is where I like to target just a 1-to-1. Happy days, right? Enter this, stop goes above this high, 10 handle stop is often sufficient. Aim for a 10 handle trade and be done with it. Maybe, 0.25 for commissions. Let it do its thing, right? Let it do its thing. So we pull back up into that inversion and then we take out that TP level. Now there are some situations where I'm not even interested in taking the trade. Like in Asian session here, we can see we're stepping down, stepping down, stepping down. However, notice how we're forming low resistance on the buy side and also relative equal lows on the sell side. I'm not interested at this point to enter short or long. Why? Because I don't know which way it's going to go, right? I don't want to put myself in a position where it's too much of 50-50. I want to put myself in positions where it's more probable or more favorable. Here is a good example from the Asian session. Perfect example here, guys. So we come up, we sweep this level of buy side. We've swept buy side liquidity. Now let's assume you're watching the session, but you're not short, right? You see that happen. It's just before a macro, right? Just before the first macro of the day. You're looking for shorts. You're a bit cautious, right? You're looking for shorts. You let the price do its thing and you're thinking, all right, I'm going to look for shorts. Now maybe you don't see anything there, which is fine. So maybe you're waiting for price. You still don't see anything. You're not too sure. Okay, just wait for price. Is it too late to enter the trade? No. No. Let's keep playing. Let's assume you haven't entered yet. And let's assume price is sitting right here. Now again, let's employ that factor that I talked about before. Use that dealing range. Go from the swing low to the swing high. This is the best way to do it, guys. Mark out the 0.5 level. Of course, the 0.25 offers a great trade, and that there is really nice. We have, this inversion gap, beautiful entry, reject, enter the price. However, we're talking about trend continuations, and what I'm looking for here, if you're curious, is this. price to pull back up into around the 0.5 level. Now we've got a sell side imbalance right here. So if price pulls up anywhere into this level or even above that and then rejects, I'm happy to enter the price and enter the price action short. So let's have a look. Still not at 0.5. Still not at 0.5. We're at 0.5, beautiful. Now we look in the charts, we zoom into the charts, and you ask yourself, is price rejecting or reacting? Now we've got this sell side imbalance, we've also got this. Right, this is an inversion fair value gap. So I'm gonna get rid of these 2 points and just leave the halfway level. We're above the halfway, which is good for shorts, really nice. Doesn't always happen like this, so it's a matter of patience, guys. We've got trend line liquidity down here, so we've got low resistance liquidity to target. Are we close to a macro? We're actually in a macro, so I'll mark that out too. These are all the things lining up, guys. This is what I look for in trend continuation trades. So we come back up here, you've got this macro here, which is the second macro of the day. Now let's see if we get some kind of reaction from anywhere up here. All right, cool. That's an entry, right? That's an entry. And the entry comes from this inversion gap. So the entry comes right here. Where should your stop loss be able to go? It should be able to go above this swing high. Notice how here you can have a nice tight stop. Whereas if you enter off the pullback like this from this bearish gap, you've got to have it above this swing high. You're increasing your risk for no necessary reason, in my opinion. So something like this should be sufficient. And what do you target? You target these lows or the bodies of these lows or 10 handles. It's a really safe target if you trade the Asian session, also the London session. So we pull back again, and what do? We take out that level. I've just given you guys a bunch of models of how I like to execute in trending markets. Number one, we're using low resistance liquidity. Number two, we're using macros. And number three, we're using the bigger dealing range to make sure we're hovering at least around that 0.5 level. The tip is to include all these things to build a model and then approach the markets in this way. But also, the lower down you enter in the move if you're looking for sells, or the higher up you enter the move if you're looking for buys, for a trend continuation, the less risk to reward you target and the more risk mitigation you have in play and the less you risk overall. So I hope this gives you guys a bit of insight into how I trade the markets in terms of trend continuations. If you like this video, guys, and you're not subscribed, be sure to subscribe to the channel. We've got videos every single week, multiple times a week, and your comments could become the next video. This is from about 3 or 4 comments on the last video, and I'll talk to you guys next time. Hope you guys have a great week in the markets. Peace.